In this video, we will discuss derivatives and hedging. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois. I'm a chartered financial analyst and a certified financial planner. I'm currently chair of accounting and financial management and for the graduate school of the University of Maryland Global Campus. What is a derivative? A derivative is any financial product whose price is derived from another underlying asset. There are lots of different types of derivatives, including options, forwards, futures, swaps, etc. And the underlying products can be a large variety of different items. They can be commodities, oil, gas, grain. They can be stocks. They can be currencies like the dollar, the euro, the yen, interest rates, like the Fed funds rate, or in some cases even things like the temperature in a given city or the amount of snowfall during a given time period. For examples of derivatives, we could have call and put options on stocks. Calls give you the right to buy a stock for some set time at some set price. The put would give you the right to sell it. You can have the same thing on cattle futures, on currency futures, oil futures, S&P 500 futures, interest rate futures, and swaps. Futures lock in a price. Options give you the option to buy at a set price, but not the obligation to. And swaps are basically sums of futures. Forward or futures contracts date at least back to the Roman Empire. Modern forward contracts were developed around Chicago in the mid-1800s in the United States. Before the advent of forwards, a farmer might produce grain or corn or cattle, take it to Chicago, try and find somebody to buy it. For example, they would sell grain to a baker. In good harvest years, there was a ton of grain, and the farmers might have to run all over Chicago to try and find a baker to purchase it. In some years, they would actually dump the grain in the Chicago River and go home without a sale. In other years, there was a shortage of grain, and the merchants in Chicago were desperate and couldn't find anybody to buy it from. Therefore, the farmers and the merchants came up with the idea of signing a contract for delivery ahead of time. This saved a lot of time wasting. The farmer knew directly to whom to deliver his grain and the price for which he would get it. And it also created a feedback mechanism. Before the farmer planted grain, he knew what he would get paid. If he didn't like the price, he could propose, well, what if I plant something else? So this created a more efficient planting system in the farmers and therefore better food production and delivery in Chicago. These were forward contracts, which are not standard, and they're private contracts between one farmer and one merchant. Sometimes a farmer might go out of business, or a merchant might go out of business, or they might want to not deliver the commodity anymore, and they would try and to sell it to somebody else. They would be able to advertise this, for example, at the fishmonger stands around Lake Michigan. Eventually, trading of these contracts was so popular, they standardized them from customized forwards into standard futures, and then those futures were traded at the Chicago Board of Trade, which was created in 1848. Again, forwards and futures obligate the contract signer to buy or sell an underlying product. It's a set price at a set time, and for forwards, delivery usually takes place. For futures, they're commonly sort of a hedging mechanism, and they guarantee, in a sense, a price, but they don't necessarily result in delivery. Option contracts, on the other hand, give the buyer of the option to buy something at some set price for some set time. Or in the case of a put, sell for some set price or some set time. The options are a lot more like insurance policies. They lower risk to the purchaser, and then those selling the option get paid like an insurance company does. Again, a long forward or future is a contract to buy the underlying product at a set price at a set time. A short forward or future is a contract to sell the underlying product at a set price at a set time. Differences between forwards and futures, as in the early ones, the forwards trade over the counter, they're customized, they're a direct agreement between two parties, they identify the counterparty. They're not heavily regulated, they're not mark to market, and since they're private contract, they are hard to terminate and have high transaction costs like selling a house. Futures, on the other hand, trade on exchanges like the Chicago Mercantile Exchange, the Chicago Board Options Exchange. They are all the same, they are standardized. Every contract on grain is the same as every other contract. The identity of the counterparty is irrelevant since there are tons of them and they are all standard. They are heavily regulated. They are mark to market, which we will discuss later, and they're easy to get out of. If you've got a long, you just buy a short to cancel it out. If you've got a short, you just buy a long to cancel it out. So there's relatively low trading costs. The profit or loss is a function of future price. For a long future, it looks like this. If you have a long future, you make money if the price goes up. You lose money if the price goes down. These futures can be used like hedgers, somebody who plans to buy something in the future, like a steakhouse that wants to lock in the price of buying cattle would buy a long future, and a cattle farmer would then buy a short future, which is sort of like selling a long future. Those people would be hedging. People who are just sort of guessing and think they know which way the market's going to go would be speculating, and they would buy a long future if they think that the price is going to go up. The short future looks the opposite. Oil producers might sell short futures to guarantee them a sale price of oil, and then the counter side of this that would buy a long oil future would be like an airline or a trucking company. And again, with a short future, just like shorting a stock, the value of the future goes up as the price of the underlying goes down. The value of the future goes down as the price of the underlying increases. The hedging process is again locking in a sale or purchase price. A farmer planning on selling corn can lock in that price by taking a short position in corn futures. If the price drops, the farmer still gets the higher price. On the other hand, if the price goes up, the farmer would have been better off waiting, but they largely do this for an insurance purpose. You don't expect to make money off buying car insurance. It just lowers your risk. Similarly, if a baker is planning on producing bread, they can take a long position in grain futures. Or if you have a U.S. company operating outside of the United States, they can lock in an exchange rate, for example, on the yen versus the dollar, by signing a contract on currency exchange futures. We will give examples of hedging mechanisms. For example, Southwest Airlines purchased long-term contracts to buy most of its fuel at around $50 a barrel before oil prices exceeded $100 a barrel in 2007. This put them in a very competitive advantage situation compared to the other airlines. On the other hand, if prices had dropped, they would have been at a disadvantage. Coca-Cola regularly uses hedging to minimize the variability in its cash flows since it makes a lot of profit in foreign currencies, for example, in China. If you want to find a list of futures, one of the places you can find it is at the Chicago Mercantile Exchange, cmegroup.com. Oil prices are very volatile, and therefore there is a large advantage to stabilizing your input costs if you are an airline or a trucking company by signing purchase contracts or long oil futures. If you are an oil producer, signing short futures. We can see these massive changes in oil prices from, for example, $20 a barrel to $100 a barrel in the early 80s during the Iran-Iraq War, and also recently, right before the Great Recession. The oil prices are particularly interesting because Richard Nixon, before defaulting on the gold standard, attempted to control prices by putting across-the-board price controls on a large variety of products. The one that stayed for a long time was oil prices, so oil prices were set by the U.S. government from the Nixon administration to the Reagan administration, and at which time futures were basically illegal. The US government set the prices of oil, and then you would have to figure out a way of distributing the oil independent of a purchase market. Reagan didn't think this worked very well and eliminated the price controls in the early 80s, at which time prices did drop, whether due to the end of the Iran-Iraq problems or due to a competitive market driving down costs. Forward contracts, again, when they are signed, no money changes hands. It's just an agreement to deliver for some set price. If the price varies drastically from the signing of the forward contract to delivery, then there's a pretty good incentive for defaulting on the forward contract, and this would be enforced through the regular markets, so forward contracts are somewhat risky to sign. To avoid this in the standardized contracts, the futures market have a so-called marking-to-market process. So if you buy a long or a short future at the Chicago Board of Trade, you have to put up money for a margin account, and then each day as the price goes up or down, money will be either removed from your account or placed into your account. This lowers the risk significantly of delivery. No one basically has ever lost money to default on a futures contract at the Chicago Board of Trade. So how this mechanism works, let's say you sign a long or a short position on gold when the gold price is $1,000 an ounce. Long has to put up a margin account of $3,000. Short also puts up a margin account of $3,000. If the gold price increases to $1,050, then $50 is removed from the short side, added to the long side. If it goes up another $50, then another $50 is removed from the short side to the long side. Then if the gold price drops by $25, $25 is removed from long and added to short. If the gold price drops by another $50, another $25, 25 more dollars is removed from the long side and added to the short side. So since you have this margin, neither party can really default on the account. A margin call will occur if your margin account loses a significant amount of money and the Chicago Board of Trade is worried that there might not, in fact, be enough money to cover your future losses. This can happen not only in a futures account, but can also happen in things like brokerage accounts. So in the previous example on gold futures, if the initial margin requirement was $3,000, the maintenance margin might be around $2,000. If you lost $1,000, then you would get a margin call and you would be told you either have to stick another $1,000 in the account, bringing the margin account back up to $3,000, or the Chicago Board of Trade would close your account and not allow you to trade on it anymore. This protects them against losses, and therefore the counterparties cannot lose money. So as mentioned, margin calls occur not only in futures, but also in brokerage accounts, and in the past have occurred in investments on stock. They were particularly important in the stock market crash from 29 to 33 that led to the Great Depression. Before that, investors could invest up to 90% leverage, so they could buy 100,000 in stock by only putting 10,000 down and borrowing 90%. Then if the stock market dropped by only 10%, they would be wiped out. So a small drop in the stock market resulted in margin calls, forcing people to sell, causing the stock market to drop more, forcing more people to sell, which therefore greatly exacerbated the stock market declines in 29. Today, the Federal Reserve regulates this, and margin is limited to a maximum of 50% of the stock price. You can still heavily leverage in the market by buying options, but then you just lose the money you invest in the option by purchasing a call or a put. You do not get a margin call. Derivatives are volatile and involve a tremendous amount of leverage. This has created multiple derivative scandals in the past. Interesting examples include 1994, when the treasurer of Orange County, California, decided to use the government's money to speculate in the derivatives market. Robert Citron drove Orange County into bankruptcy at that point in time. The Orange County Register's response to this was, why don't we just privatize everything in Orange County? Another example of a derivative scandal and bankruptcy was in 1990s. Nicholas Leeson, who worked for Barings Bank, one of the United Kingdom's oldest merchant banks, drove the bank into bankruptcy by trading on derivatives on the Singapore International Monetary Exchange. So he was able to trade a ton of money that belonged to Barings with basically no oversight. A more political scandal involved Hillary Clinton in 1978. She invested $1,000 in cattle futures and in only 10 months was able to turn this into $100,000. For whatever reason, her broker did not require her to obey the margin requirements, and many people have speculated this is a mechanism for money laundering. She was accused of using futures to money launder a bribe from Tyson Foods. The way that would work is the broker would just have two contracts. They wouldn't put a name on them. And if the price of the cattle futures went up, they would assign it to Hillary, and they would then sign the short to Tyson. On the other hand, if cattle futures went down, then they would assign the short to Hillary and the long to Tyson, and then the broker could get away with just backdating the margin purchases on cattle futures. As the future expires, the future price has to go to the spot price. But the way it does that can vary in multiple different ways. Either it can stay roughly the same, it can go down from a high futures price to the spot price, or it can increase from a low futures price to the spot price. If it goes down, this is called being in contango or forwardization. If it goes up, this is called normal backwardization. So normal backwardization would be behaving like a bond or over the long run a stock. Gradually the price increases, you want to own the commodity or whatever the underlying is, and you make money over time as it increases to the spot price. Contango can result when you, example, have very high storage costs for oil, and people would prefer to buy the oil later so they don't have to pay for the storage costs now. I thank you for watching this video on derivatives.